Good morning, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for October 6th, 2021. We're going to take a look at our row crops today. Obviously, energy markets are one of our big movers here in the futures. We don't usually cover them here in the strategy of the day update, but crude being down 2.25%, natural gas coming off its highs. I think it is worth at least noting and taking a quick look to start the day at those two markets, because they are certainly big drivers of some of the outside macroeconomic forces that have been, well, maybe keeping corn prices better than expected. Now, remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you are interested in turning them into more trade recommendations or getting a little bit more insight, check out every Thursday at 2 p.m. and sign up in the links in this comment section and in the info section of this video for that strategy of the week forecast, or webinar, I should say, where I try to give some more actionable forecasts and look at the market, where we take a look at option strategies and other tools that we can use in our belt as a trader to try to manage our risk better, from both a marketing perspective and a trading perspective. So let's actually open the door here today with crude oil. I've got a 4-hour chart that we're going to pop up here of the continuous contract in crude. We've been in a pretty good uptrend, and in fact, this uptrend has been pretty well defined by a channel. We have been unable to break above a key psychological $80 per barrel level here, and we're starting to fall back today to test, broken resistance now as support that comes in around that 77 to 76 area. It's the highs from July, the highs or summertime high. It's the highs from September. Nevertheless, a broken trend line here that went through the highs resulted in a pretty good short covering rally. We've got trend line support drawn from this August 22nd low through the lows here at 70. That trend line support comes in down around 74. And I do see the high likelihood now that we have an outside day reversal. Again, the highs here today of 79, 78, lows of the day of 77 are outside our prior day and starting to reverse this market lower. We've broken our simple trend line from the last week of trade, just through the lows here that were through the daily lows, and could be ending a trend higher. Now, the real question, though, is just where does support come in on this market for crude? And in the near term, I'm looking and very interested in a full 50% retracement from our 62 lows here, 61.70 area lows here from August 22nd through the highs of the market. And that would bring us back to a 70 to 71 supportive area. It aligns with maybe the lower sloping channel of the larger lower sloping trend line of that channel higher that we've been seeing, and it'd be a very nice healthy pullback for this market. Crude oftentimes likes to set up into $10 ranges. Good example of which was actually the $15 range from the 77 highs here down to the 62 lows that we traded in consolidation there through from the July highs through August to then reverse mid-August through the rally that we've seen here today. So this 2.5-month rally that we've seen, getting some correction on a pullback, not a terrible look in the market to start. What goes up must go down, so to speak. All right, taking a quick look at natural gas here, we've got the November contract up. Very toppy type of formation here, and I think really for natural gas, it's important to move ourselves out to that weekly time frame to see how range bound this market's been for the last decade. We really haven't pushed above $6 in the natural gas here since pre-2008 recession. There is no real global supply issue with natural gas. In fact, when we shut off oil wells and don't pull oil out of them, it's almost impossible to plug out and not continue to get natural gas from those wells. So natural gas supply from the ability to get it out of the ground is almost never ending. The issue is, of course, where do we put natural gas and keep it moving through the supply chain? So it's more of a logistical issue, as we're seeing in the UK with natural gas prices hitting record highs. That's more of a logistics issue of getting natural gas to that country rather than, and of course, maintaining supplies quicker than demand is using it. And as many supplies have been rerouted to South America, and there's all these different things going on, but it's mostly a supply chain issue more than an actual and a storage issue more than an actual mining or getting it out of the ground issue like crude can be. So with that being said, once you reroute tankers, once they go, find their way to try to marginalize out that basis, you're going to get a collapse in pricing in those next to the woods. And this panic buying we're seeing in LNG will subside quickly. And as you can see, past peaks here have lasted. This is a weekly chart. Let's look at actually a daily chart here, so you can see how many days it takes for natural gas to pull off of its highs. Here back October, this is actually a pretty good example. Back in the early 2000s, the move from $8 to $10 here lasted for about a month before, in just 1 week's time, we fell over $3 lower in natural gas. A massive move for the market at that point in time. Going a little bit forward here in time in 03, I mean, we spent basically 2-3 days of trying to break above $7 to $9 when it finally went. Could we see that type of move this time around? Absolutely. But then you only take about a week or so for the market to fall back down to what would have been normal levels at that time. Of course, the big spike in 06, we lasted a few months up at those prices. That was much more, there were more things going on at that time. And then you have the run up to $14 there in 08, which was much more panic around in an energy crisis that was going on in crude oil at the same time, when crude was at $100 a barrel. We don't see those global energy prices in justifying, in my opinion, LNG going much higher than we already have. Now, I think this is much more akin to the rallies we've seen over the last decade. Let's use the rally back in 14 as another good example. We had a quick spike above $6. We didn't stay there for more than 3 days before, in 2 days' time, we fell all the way back, losing $2 off of this market back to 440. I'm not necessarily saying that is what is going to happen here today, but we just need to slip back below $5, in my opinion, break a trend line here for natural gas that is drawn through the lows of this market here, that comes in around 525, and I think we'll find our way back towards $4 here rather quickly. The old congestion zone that we broke out from was around $3.50 to $4, so I would imagine this market wants to come back to test that level. If we hold support, we continue to see supply concerns, and we have a really cold winter where we see continued draws on stockpiles. I see no reason why LNG couldn't go higher, but it's very hard-pressed, I think, to think that this panic buying we're seeing, unless it continues the short squeeze we're seeing basically from here and now, is probably going to run its course here in the near term. But we'll see what happens. More importantly, let's get into our row crops today. I want to begin first and foremost with soybeans. Let's bring up that daily chart of soybeans. Take a look at what we're, where some of those daily moving averages are. Update us and remind us that we have a congestion zone below us here, around the $12 to $11.50 area. The 1150s is the 50% retracement of the contract lows from 820 to the 1480 highs, and we are of course holding below our trendline support that we're holding from our June lows through that August low. Failed to break above it here just a few days ago with that push up to 1295. We've fallen back down, made our way below 1240. That was the big indicator that, hey, we're getting that pressure to the downside, and we're probably going to get some kind of capitulation. I don't think that capitulation's over yet, especially today, testing 1240 as I speak. I'm expecting a slide back below that level. 1230s will be very quick to come. And then a move down to $12, I think is no guarantee in any market, but I think that is in the works here. We're now below on this November contract. We're below that 1281 200-day moving average for November beans. The 18-day moving average is falling down now. Just did a bear cross below that 200-day, trading at 1272. 55-day moving average is now down to 1310. Look for that as any kind of resistance. I'd imagine it would take us a couple days to get up there. That moving average is probably going to slip below $13 here and act as resistance on any kind of rally, major rally that we'd see. These 2 to 3 day short covering rallies always seem to find their way back to test that 100-day moving average. But if we find ourselves in a protracted capitulating downtrend here, we'll be heading lower here without really testing it. And of course, the 100-day moving average, I meant 55-day there. The 100-day moving average trading at 1335. That's probably going to drop its way down here back towards the $13 mark as we head lower. But we are well into harvest, and actually I have us more around the 40% complete probably for beans at this time. We've obviously got some weather. Looking out the window right now at some storm clouds and some rain, enough dampening weather to slow down that harvest pressure. But now that we are well into and going to be passing that 50% mark, this is seasonally when I personally look for that seasonal type of low and harvest low to have been priced into the markets, right? Elevators across the country have already seen the big inflow of grain. They can, judging by that, just looking around the area, how far harvest is along, they can start making pretty good estimates on how much more grain is going to make it through and cross their scales. And that hedging pressure and that selling pressure that we see in the markets this time of year, particularly on the board, is going to start to wane. And that is a fundamental notion on the market that we continue to watch. However, the technical trade is still pointing lower into the downside here. So let's flip over to our 4-hour charts real quick. Take a look there to see how we've been trading in the soybeans. An interesting level that we talked about here in the Strategy of the Week update. And again, I urge you to join me for that webinar every Thursday at 2 p.m. if you haven't signed up for it. I also took a look at this at the Strategy of the Day, I believe in the Strategy of the Day webinar. No, it wouldn't have been, because my last Strategy of the Day I did the morning of our quarterly grain stocks before the sell-off that really, basically sold us on the idea that we're going lower, or confirmed that idea. You can see highlighted blue here is a very interesting type of Fibonacci pull that is done. In this case, it is a low to a low in the market. It's what I refer to as an extended pull or an extended short. These are usually more in a short, in a downtrending market are used. And it's when the market just sells off so much that we don't end up with a full 50% retracement from some kind of swing high to swing low. In this case, you might call this a 25% retracement we saw that day on that daily candle. But I like to use the low of the prior day, in this case, to the new low as your fib. And the reason is because of how we pull it here in a second. You can see how we traded up to the 1261 at 60 area as resistance that day. We sold off down to the below the 1243 target. Same anchor, new low, all the way down here. Gives us our next fib pull. The next area of resistance from that fib was 1250 to the 1252. As long as we remain below that 1257 to 1258 area, as we did, our new downside target is, I'll highlight it blue again for us here, activate it. There you go, is down. Now this next swing should take us down towards the 1221 area in November beans, particularly now that we are breaking below the swing from our low to high here. The 50% level has given way. The 61.8 here at 1240 is now fractured again, and I expect us to now go and head lower now in this market down towards that 1221 area. Of course, the full swing from highlighting it blue now. There you go, from the 1297 highs here. Get the exact high there. I think it's 97 and a quarter. Yeah, down to 1231. You've got a new resistance zone up around 1264 if we get up there too, but I think with this extended short holding, the market has an algorithm, a technical selling algorithm that is going to continue with prices lower. Not to mention here, this old resistance zone, right? You could call it, obviously I think 1241 is a key technical level, but let's look at all the support that held after that 1241 low, right? It was all clustered in this 1258 to 1250-65 area to start with back in June. And then, more importantly, here through July and August and September, I should say, 1277 lows here from July, September, August. But then the lows, all these lows from 1270, 1264, 1262, 1261, and 1258 from September that was holding the low end of this expanding range, if you will, that we were in for pretty much the whole month of September in that sideways price action before we broke down after quarterly grain stocks. That is now broken support being tested as resistance here. We got a big reaction off of it today. I think today has completely erased any of the bullish notion from yesterday's reversal structure and holding, certainly I think holding below the 1258 area now. I am bullish below, bearish above, or bullish above, bearish below that 1258 area in the near term. We're going to need to see this market overtake 1260 for me to even reinstate the idea that we can get back to 1300. And certainly if we were to get up there, we're still going to have this downward sloping trend line and mess of highs to have to break through which will eventually, in my opinion, happen. But I think that capitulation lower now, the flush out to $12.20, $12, and honestly, the 11.80 to 11.50 landing zone that I've been looking for feels like an eternity now in the beans. I think that is where China and other big export markets are going to be willing to come back in and show us where that demand actually exists, because that's the big question now. We already know what yields are. We already know what production is. We've been arguing over just a couple bushels an acre on a national average and just a couple million acres, if that, on total production. That argument has been priced into the markets at this point in time, and I believe we're now into a demand question, and not the lack of flash sales, the being behind on the demand scales. And by the way, now the Biden administration going to the table with China and getting some trade delegates meeting to see if they want to keep the Trump phase 1 trade deal and phase 2. They're trying not to call it the Trump trade deal, but it's what it is. We've changed nothing since Biden administration took over, and it's looking like they're going to be keeping that trade deal in place. So love them or hate them, Trump did a good job of keeping a trade platform in place for us. The question is now we're going into a renegotiation of that trade deal, and that could go either way. Even in the face of big tariffs, though, last year, if China repeats history, we're going to expect to see massive pork purchases. We're going to expect to see massive corn and bean purchases, and expect all the saber rattling and political jawboning that goes on over the next few weeks might not mean a thing, because when push comes to shove, all that matters is those export sales, and what we see come through as actual sales to China. And unfortunately, let's pop over to the U.S. dollar, because this is something I know that our Asian counterparts are probably watching, and all of our trade partners are watching, because as we are also now falling in the beans, we're watching the U.S. dollar continue to rally. And the question is, of course, where does that trend going to end too? Because you could look at the price of beans as either a factor of how expensive they are in terms of U.S. dollars, or how expensive they are in terms of what our trade partners are going to be paying. And if you look at them in terms of what our trade partners are really paying, the outright price of beans isn't fluctuating as much as our dollar is sometimes. And that that currency fluctuation can be a much bigger proponent of trade decisions. We know that the falling U.S. dollar over last year was a major windfall for U.S. producers. It allowed for China to come in, pay whatever price we wanted in U.S. dollars for our beans, because they were getting a discount via the currency swap. And I think that that's something that we might be seeing right now, is purchasing of the U.S. dollar. Hear me out. Purchasing of the U.S. dollar to front run future ag purchases, right? If you want to come and do business with a U.S. company, you're buying oil, you're buying U.S. steel, you're buying agricultural products. We don't accept Chinese yuan. We don't accept Japanese yen. We don't accept other currencies, right? We only accept U.S. dollars. So you need to have a vast treasure trove of U.S. dollars to come here and do business to begin with. Now, China ultimately has a lot in terms of domestic stockpiles of U.S. treasuries, notes, and of course our currency as a reserve, which they tap into and use. But if you continue to use your reserves of U.S. dollars, you're going to end up decimating the value of your currency on an international stage. So one thing you will often see is a front run and a run up of the U.S. dollar before many of these purchases start to happen. And what they'll end up doing is currency swapping that out. They'll use that U.S. dollars that they've been purchasing, maybe through March of last year when we ran up above 104 in the dollar index. I think that move from 95 to 104 was international purchasing of the U.S. dollar, swapping out foreign currencies for the U.S. dollar, in an effort to then come and buy our export products. We then saw record exports of pork and row crops over the period following that purchasing. Well, I think that this run-up we're seeing from 89 to 94 is much the same type of move in our currency that is eventually going to result in another downtrend in the U.S. dollar. Whenever that begins is probably when the actual purchasing of our ag products are really beginning. And hopefully this time it won't be just from our nose, because prices are ultimately much better in terms of U.S. dollars than they were back then. So the U.S. dollar kind of head faked us. We were looking and watching a potential for it to roll over there with that head and shoulders pattern. Now we've got a very clear trend higher. trading back above 94.30 here, back to test the contract highs of 94.50. Seems like it's in the works. And most importantly for me, I'm watching the full 50%. It's a fib. It's just the 50% line. That's all I really care about. There we go. It's pretty dim on this chart, but really we just care about this 96.40 gray line here on the chart. That's the 50% level of this entire decline. I think that the market's going to probably head up to that 96.40 area. And again, that's a pretty good test of the old support on the dollar. You see a cluster of lows here between 94.80 and 96 over the last couple years that we are holding above. And in late 2019, I think that this is the market coming back up to test that area before resuming a downtrend lower. And that's something we're going to continue to watch. So a little bit higher on the dollar here, probably going to weigh on some of our markets like the beans. I think it's going to give us some trade headwinds against wheat here too. But we're going to continue to monitor that, because if we do get up there and start to roll over, there's definitely no reason that the US currency, I think, has peaked just yet. But once it starts to, I think that is then the one of those signs from the market that those US dollars are now being swapped for commodities and then eventually repatriated back to those foreign countries, buying our exports as their international currency. And that's going to have a negative effect on the dollar. All right, with that being said, let's take a look at the daily chart for corn now. We'll go into wheat here too, and maybe cattle and hogs if we got time. 3 days lower for corn now, higher highs and higher lows. Today was a bit of an outside day, but really, beginning a down day here. The 18-day moving average is currently holding a support around that 530 area, but this 55-day moving average is being a stubborn son of a gun. 541 last on it, and has been resistance. That green line on the chart has been resistance for this market for the last week. The 100-day moving average at 548 seems to have stopped us in our tracks as well. This, to me, looks like a market that's beginning to roll over. We've got that bearish crossover of the 55-day over the 100-day. And if we break, much lower here, the 200-day moving average at 515 is going to come into question as well. Much like soybeans, we broke below that trendline support that had been holding us up and creating that wedge-like structure for the last several months in corn. Now we're back below that level. We traded in 3 waves higher to test it as resistance again. And now the market is starting to really start to roll over. Now, the $5 mark, I think, is a good place for this market to come back and test. And again, let's take a look at the 4-hour chart of December corn, because I think there's where you can more clearly see both the open gap below us and kind of that landing zone I'm maybe anticipating for corn as well. So a slip below $5 where we have a bit of a double bottom, I think is going to result in a 20 to 50 cent kind of slide lower. I find it hard for December corn to get below 450 at this point, but doing so would allow us to continue to build carry into some of those back months. As you've seen, December 22 corn has basically gone to parity here with December 21 corn, and I do expect it to remain as a good carry trade here over the next few months, building some of that premium into December 22 corn. So maybe when it comes time to bottom here, maybe not even looking out to March and May, maybe we look to December 22 for some of our longs. The problem, of course, is going to be time value premium that we'll end up paying in those markets. But nevertheless, December corn from the 594 highs down to the 497 lows, 50% retracement there at 545 comes in and starts to hold this market. Equal legs up. That first swing we had from 497 up to 536 here, extended from the 512 lows, came in at 552. We didn't get up there, but we are starting to break, unfortunately, below the trend line support that has been holding this trend higher. Next area of support to the downside here, if we take a full 50% retracement, this is assuming we break below 530. The full 50% retracement from the 497 low to the high comes in around 522, but I'm not expecting that area in this market to hold. This has been a pretty choppy move higher, and I am expecting a swing down towards 480 for December corn at this time, so long as we remain below 550. So my line in the sand for December corn now 550, bearish below, bullish above. We get above 550. I think a move towards $6 is probably going to be in the works again, and at that point we'll probably continue higher. But in the near term, I think we need to have that capitulation head lower here on the chart finally fill gaps at like 477, clean up the chart, maybe go a little bit lower towards 450 before inevitably turning higher, basing for the year and establishing a new harvest low here over the next couple of weeks. So we'll see what happens. On the 15-minute chart, we've had some sideways price action here today. Pretty choppy markets. Again, this 527 to 530 area, we start to break below there. I do think we'll see an acceleration lower. But for right now, you can't argue. It's kind of a range between 548 and 528 at this time. But this trend line we have against the lows here now that broke here today after the open, that is one of those maybe nails in the coffin in the short term for the December corn that we're going to have to continue to watch here. All right, now let's look at December wheat here on the daily time frame. Very much a range that we've been in, and arguably very impressive, having now traded and kind of held above the 578 area. That was old congestion zone, the old highs, went above, held it as support, broke below it for a few days, but ultimately came back above it, now held it again as support. This market doesn't look like it's ready to give itself up yet. Obviously, we have a two-day reversal here and now lower lows and lower highs here for the second day running. If we do get a bearish hammer close, you know, if we close down around 744, the low end of close to the 740, it looks like the market's going to want to come back and test towards the 730 area. 55-day moving average down at 723, 18-day moving average at 718, and the 100-day moving average at 701. Wheat could pull back 40 cents here and still be in an uptrend. So long as we remain above the $7 figure at this time in this upward sloping trend line against the lows, I think there's a good opportunity for wheat to continue higher. However, we slip below those levels and certainly slip below this old congestion zone at 678, which, by the way, is where our 200-day moving average is. Wheat's probably opening up its doors to test the low sixes again and the low end of the range we've been in. And boy, does this look like a market that's slowly trying to carve out a top here in the near term. Might be a head and shoulders pattern forming on this daily or weekly time frame as well. Whoops. Left shoulder here formed up into the 760 to 750 area. Right head here up at its peak at 780. And the right shoulder might have formed here just days ago. We would expect the neckline, though, of this move to be down around 627. So, again, it's a massive daily or weekly type setup. We break below 620. That, I think, would definitely end the uptrend, break below all of our upward sloping trend lines, and probably see a resulting move below $6 for wheat. But that's way too soon to call it, and not even worth really talking about, but something to keep in mind in case we start to break down. In the short term here, wheat broke above all of its downward sloping trend lines against the highs. We are still holding a highs to highs extended long here. Again, below 740 breaks that level. Next area of support will be 730. That's from the 701 swing low to the 763 highs. Look for that 730 to 720 area of support I already talked about. And of course, the full swing from 676 all the way up to 670 or 763. 720 is the full 50% retracement for wheat. And again, I think we could see a 20 to 30, I think conservatively pull back for wheat and still be in an uptrend here in the near term. So that's something to consider, think about, be cautious of in case we start to settle and slip back down below 740 here today. All right, Ken. Let's take a quick look at cattle. Our hogs got them up. Perfect. All right, so hogs, a little bit of a gap down today here in the chart. I got a 4-hour chart of hogs. You got open gaps down on 777. I would expect the hog market to continue to hold support before we even get down into a gap fill. So this old kind of supportive area that we had and that we formulated our range from, now also the gap fill at 79.80, or I should say the gap up at 79.80, lows down around 77.20. Hey, Alex, how are you? Get out of my shot. I would imagine holding support before we fill the 77 gap. I would be more concerned. I'd be very concerned, I should say, with the uptrend if we get down to 77 and fill that gap. That would be right around the 6-18 line of a full 50% retracement. And honestly, bull markets don't fill their gaps. They test, maybe the gap up area as support and then head higher. I would love to see us get up to trade the 82.40 area where we gap down from. That, I think, would be spark some buying here in the near term and maybe give us a short-term reason for the market to be heading higher, but we'll see. 78.46 is the full 50% retracement now for the month of September. September lows to October and September highs here up around the 85.65 area. So, pretty impressive move for the hogs. Can't deny we had a downward sloping trend line against the highs. Get the right tool here. From the 89 half highs through the 86 quarter highs through the 83 67 highs. We broke above that area. We came back down here. Today was what I refer to as the KYM, kiss your mother, touches the line as broken resistance, as support before maybe heading higher. And so we're going to continue to watch that area as support now. Again, maybe some support down into 78, but I would not expect this market to trade that 76.50 or 77 area gap fill if we're going to continue higher in the near term. And let's take a look at live cattle real quick. Don't know where on my charts. Out here it is. Yeah, live cattle last week a couple weeks ago we broke above the trendline resistances. Now we've got new trendline resistances we're starting to try to break above, right, in the shorter time frame. Monday's reversal higher looks like a good market, trying to stage a bottom here for December live cattle from 125. We need to see some follow through up to 130 and certainly a test of 132 and a break above to constitute a real reversal here. But we just came back down to test our old support, from earlier this year, the breakout levels for December live cattle around the 125 area. We continue to hold that level. We can reestablish ourselves above the old resistance and old support here, this next kind of congestion zone that the market had here between 130 to 132. That would get me going again for live cattle, but it does seem like the market is now trying to stage a reversal with an outside day here to start the week. Higher highs and higher lows yesterday with a lower close wasn't great, but certainly a nice sweeping reversal here today. We close higher. We close up around 129. I would say that this market looks like it has staged a reversal and is probably heading towards the 132 area for a test of that full 50% retracement. I would also make a good argument that we'd probably continue higher from there, but that remains to be seen here. So with all that being said, I hope you enjoyed today's strategy of the day recap. We covered a lot. We got some energy markets in there for you. Looked at all the row crops and our cattle and hogs here in the near term. Remember, if you ever want to get in touch with me, I'm always here to talk and always interested in finding ways to earn your business, certainly. My number, 312-277-0110. Give me a call. Find me on Twitter, right here at Dan SOTD on Facebook. Got the SOTD page as well. You can find links to sign up for that Strategy of the Week webinar, of course, in the comment and information section below. Leave your likes and comments. Always want to hear what we can do better for you in these videos. Have a great day, everybody, and we'll be back with you tomorrow and as price action develops. Take care, everyone.